Let's now quickly take a look at the fixed income markets for Thursday and see how the trading session is going at the moment. Robert Omotunde is the head of research at AfriInvest and he joins us from Lagos. Good morning, Robert.
Morning, Bolaji. Thanks for having me.
Thank you for your time. Let's begin by taking a look at the interbank money market. Of course, all eyes are in the market following the suspension of 9 banks, which reduced to 8 after the reinstatement of one of the banks, which said that it had actually complied with the directives of the central bank in refunding the NNPC oil receipts to the coffers of government. But how did the market play out yesterday?
Well, the fixed income market, what we begin to experience is the general lull in the macroeconomic environment, which is also feeding into the investment climate. So yesterday we saw some very strain in the treasury bills market, which also dovetailed into the bonds market. And we see on the average yields rising on both markets. I mean, for the treasury bills market and the bonds market. But generally, what we can say is that we still have more attraction for major fixed income instruments, especially instruments within the benchmark range of the GMO.
Okay, but it seems that more pressure is being put on short-dated instruments, and that has always been the case. So that seems to have happened as well yesterday.
True. What we've noticed across board is whether you're looking at the treasury bills market or the bonds market, investors continue to be attracted to shorter tenured instruments. And this is explicable by the fact that if you check along the yield curve, you will see more attractive yields. You look at treasury bills, for example, yields from 182 to 364-day instruments are trading at as high as 18% or 20% in some instances. And if you check in the bonds market as well, we see yields as attractive as 18% on the average for instruments that are on time to maturity of about 2 years. Although on the average for the bonds market, we have yields still trading on the average at about 16%. So the general sentiment in the market is that most investors would rather want to play within the short end of the curve, given the general risk environment, which is not so attractive to most funds who wants to play at the longer end of the curve. So we'll still begin to see some attraction towards the shorter tenor instrument, both at the the treasury bills market and the bonds market.
So does this affect the level of liquidity in the market as well?
Well, liquidity has been basically driving investors' appetite for most of the instruments. You will notice that for some time now, the central bank has been very aggressive in its liquidity mop-ups. We've seen a flurry of more auctions as well as treasury bills auction coming to the market. Last week was particularly interesting because we had a number of OMO auctions as well as treasury bills and bonds auction. Again, next week, we are expecting another 200 billion worth of treasury bills instrument to be auctioned. And this will be, will be dictated by the level of liquidity. How investors are going to play in that market next week will be dictated by the level of liquidity in the system. Already, FAC allocation is expected to come in today, which in some instance should also assist the level of liquidity in the system. But what we've noticed is that the central bank at this time is aggressive
as well
in trying to attract a lot of investors, and will most likely take some proactive action once you can see some level of liquidity in the system.
So we should expect some kind of stability in rates next week based on the FAC inflow and a mop of action from the Central Bank of Nigeria. Thank you so much, Robert Omotunde. And thank you so much for watching Business Morning. We do appreciate your time with us. We hope you join us again, same time on Monday. I'm Bolaji Akinwale.